let's discuss now. It is a Friday special, and we have a key guest who's going to be talking about the impact of, Israel-Hamas conflict, oil on the Indian equity markets, about the low float of stocks perhaps, and all of that, even the FII trend and what kind of bearing, how large caps have been doing well, not doing well as compared to the broader counterparts. But without any further ado, let's get in. Prateek Agrawal, the Executive Director of Motilal Oswal AMC. Morning there.
Good morning.
All right, I'm going to start off by directly first. Thank you so much for joining us and taking out the time to have a conversation here. But I'm going to start off by asking you about your assessment of why, overall, how do you see the markets right now, given the kind of geopolitical risk that we're sitting at, given the kind of some amount of selling pressure that is coming in from FIIs, why the large caps aren't really doing well? And do you think the outperformance of perhaps broader counterparts will continue here on?
Yeah, let me construct it like this. Outperformance lies in a part where earnings growth is higher. Now, from the bottom of COVID lows, if you see, the mids and the smalls have done substantially higher earnings stagger versus the large, in part because of very strong and supportive government policies. And I think till the support continues, this space could continue to outperform. Even now, if you see, most brokerages, for example, would put out a number for the Nifty kind of an index and would put out a number in terms of growth for their coverage, which is the broader market. And typically, the coverage would have a higher growth versus the Nifty itself, which points to more buoyancy X of the larger caps. Bond yields are high in the West. US bond yields are crossing 5% on 10 years. Now, with that kind of bond yields, one should not be expecting FPIs to put in money overall into emerging market. We should be expecting investors there to be moving to debt rather than to equity. What India has seen is a benefit of, to some extent, substitution effect. Maybe people have taken out monies from other EMs and put into India, but I think it is reason to expect FPIs to continue to be sellers rather than buyers. They own more of the larger caps, and that is a part which should then be expected to see continuous amount of selling pressure. The thing is just the opposite on the mid and the small cap part of the market, where after a long while we have some structural inflows. So if you see domestic Indian money, it is structural, it is coming in on the trot. We are seeing what has happened in China between 2008 and now, beginning to be seen in the country over the last 2 years. And happily now SIPs are a larger part of total, and half of that money comes into mid and the small cap funds, which is providing this space a lot of strength, because otherwise it was just the top 100 companies which were getting money. Now mids are the next 150, smalls are everything else. They have started to get some flows, and yes, the start point of all of this is better earnings growth, better flows, and then better ability to raise monies for growth. So it becomes a virtuous cycle. We hope it continues. Key thing there is supportive government policies. Now, your next one, which was geopolitics, Israel, etc. So frankly speaking, war is never good, but I should not say this, but war is good business for people who are not indulging into it. Happily, our country is not trying to benefit for it, so we have a high moral ground. The risk that is there. So on oil, let me just make one simple statement. That's the biggest risk. The war is going on around the areas where which are oil producing, and that is the sensitivity. Now, oil production and demand are very well balanced. In fact, oil production had to be cut to sustain prices at 85. Now, in some manner, the way to look at the market is that we are building in a $5 premium for risk. Hopefully, as things settle down and people understand that this will not flare up, we could see fall in the oil prices to 80, 85 kind of a level. That said, if you look at Indian exports, imports, trade data, the sense is if you extrapolate last month trade data, we could end at 1.1, 1.2 current account deficit, which would still mean because of capital inflows, the country gets 20 odd billion dollars of excess dollars into the country and the reserves go up. So, in terms of sustainability, a brief spike to 100, even over 100 could be sustainable. And my sense is, hence, we should not expect the growth impetus that the economy has from the government, from the policymakers to be dampened below 100. I think till then, the government would allow the economy to grow on the trot. After that, maybe we will see some measures to slow it down. Till the economy grows the way it has been, I think it continues to be time for alpha.
Sure. Prateek, I also want to understand, as an AMC, now amidst Middle East tension and the oil boiling to the level that it is, and perhaps you citing that as the biggest risk to the equity markets and India economy put together, what kind of theme are you focusing on?
No, so we are high quality, high growth investors, and try and chisel out very narrow spaces in the market which can offer longevity of growth and a quantum of growth which is seriously higher than that of the index itself. So spaces like new tech is something that we like. Spaces like hospitals in the healthcare space, MidCap IT services which are not headwinded because of the BFSI slowdown, let's say, or issues in the West. Let's say in financials, we want the retail focused banks where AUM growth could be stronger because it's AUM growth which will result in profit growth as we go forward. The base effect and the lower NPA effect is wearing out. Defense, engineering, where the longevity of growth seemingly is quite long. Given the Make in India thrust and the focus to increase manufacturing as a part of the GDP. So, and yes, China Plus One is a large theme through EMS companies and maybe through chemical companies. Some bit of this is definitely experiencing a bit of headwinds just now. So our portfolios today tend to be more inward looking, more domestic focused than external focus. So we are underweighted IT, we are underweighted, typically speaking, export oriented businesses, more domestic focus. So that is how it is.
Sure. Prateek, I just want to understand one thing. As an AMC, is this a conscious strategy to stay away from anything which is related to crude-related strategies or the derivatives thereof? Are you just going to be avoiding that entire basket that you can look at? It could be the oil marketing companies, it could be paints for that matter, the defense space, even given the kind of geopolitical concerns, reasons around that. What is your perspective around the three categories?
No, so defense, we are invested. We think it is a very long period theme. It is having a lot of tailwinds. I think the thing which caught the eye and has been amazing, me in particular, is the government putting out list after list of items which they will not import. It has to be made in the country. Never been done before, and this just takes away any uncertainty. In a democracy, you put out a list in the public domain saying this will be made in the country is a huge statement. So I think it is a very long period theme. If we substitute more and more of the imports as we go forward, I think it gives you a visibility that other spaces may not offer. Coming down to your next space, oil, there is no way to hedge oil prices in the country. Our upstream oil companies and oil refining and marketing companies in the manner in which, in the order in which they function, almost target one kind of profits, maybe related to volumes, but not margins. So government comes in and puts in a tax or the other, so upstream would get 70, 75, around $75 pricing, not over that, and refining and marketing also something or the other to the effect keeps happening. In one period they make more money, in the next period they make less. Now, in some manner, targeting amount of money they will make in a year, and in between acting as a cushion to paper out volatility of prices. Now, alternate energy providers like coal, once again, the auction volumes, are not going up. It is more of the linkage coal. It is more of the coal which is sold at almost predetermined prices. That is where the volumes are going up, and which means the profit increases would be more in line with production growth. It becomes very, very difficult to hedge against oil prices in a country like ours, which is such a large importer of energy. Now, that said, something very interesting is happening just now. We are importing 40-45% of our oil from cheaper sources in the Middle East and Russia, and that I think gives a benefit of between $5 and $10 billion to the country in a year, distributed between the government as higher taxes, oil companies as maybe higher margins, and manufacturing once again as higher margins in some manner. Which is seen. So I think as such, very little manner of protecting against higher oil, but I think if you get cheaper import versus your global competition, then manufacturing is one way to protect against this, because they get an edge versus other global players.
The last question that I have for you is, what's your view overall on those low free, the free float stocks, which perhaps have got into a discussion mode where the low float stocks have been gaining traction? There could be in the likes of PSU metals, public sector banks, and even some private spaces. Would you want to talk more about that? How are you looking at it?
So, let me say this. Today, we see the government working harder than the private sector. Okay, and you speak to many of the private sector chieftains, they would happily acknowledge that. And we do believe it is working to a plan. I can say this, I have relatives in the government who are working harder than I am. Okay, so why should, economy is doing well, why should PSUs, who are still having a very large part of the economy, not participate well? To start with, they were cheaper, a lot of their issues got sorted out. So, I think the long period themes are correct, that over a long period of time, private sector does better because they sustain whatever pace they are doing. PSUs, after a very long while, are showing what they are showing. That said, yes, in the marketplace, always it happens when markets are buoyant. People try out various things. And one thing is very clearly, spaces where liquidity is less, get cornered and move up sharply. Happily, if you see the portfolios of institutions, you will hardly find those kind of names. So it is very, very retailish kind of activity. I think the private sector entities may take advantage of it quicker by selling some stock and making use of this spike to raise money. Government there takes a slightly longer time, but one should expect the government to also do the same over a period of time.
All right, Prateek, we are going to leave it at that. And thank you for taking out the time and speaking to us this morning.
Thank you.
All right, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us at the link at the bottom of your screen. And for the rest of the page, stay tuned into moneycontrol.com and Moneycontrol app.